$11 trillion. That's how much more debt the world added in just the last 3 years. To put that in perspective, if you spend $1 million every single day, it would take you over 30 million years to spend $11 trillion. But here's the terrifying part. This isn't just some abstract number that doesn't affect you. This debt explosion is literally making your money worth less every single day, and most people have no idea it's happening. Today I'm going to show you exactly how this hidden crisis works, why it's accelerating, and what it means for your wallet. Let's start with the basics. Global debt isn't just government debt, it's everything. Government bonds, corporate loans, mortgages, credit cards, student loans. All of it combined now totals over $300 trillion worldwide. That's 3 times the size of the entire global economy. Think about that for a second. If every single person on Earth pulled together everything they produced for 3 straight years, every car, every service, every grain of rice, it still wouldn't be enough to pay off our collective debt. But here's where it gets really wild. This debt isn't growing linearly, it's accelerating. In the 1970s, global debt was about the same size as global GDP. By 2000, it was twice as big. Today, it's 3 times as big, and the curve is getting steeper. So why is this happening? The answer lies in something economists call the debt trap cycle. Here's how it works. When governments or businesses need money, they borrow it. But borrowed money comes with interest. So they need to earn more money to pay back both the principal and the interest. If they can't earn enough, they have 2 choices: default or borrow more money to pay the old debt. Guess which one they usually choose? This creates a snowball effect. Each new loan makes the next loan bigger. And central banks around the world have been enabling this by keeping interest rates artificially low for decades. When money is cheap to borrow, everyone borrows more. Governments borrow to fund spending. Companies borrow to expand. Individuals borrow to buy houses and cars. It seems great until you realize the math doesn't work long-term. But here's the part that directly affects your money. All this debt has to be paid back somehow, and there are really only 3 ways to do it. Option 1, economic growth. If the economy grows faster than the debt, then technically we can pay it off. But remember, debt is growing at 7 to 8% per year globally, while most economies grow at 2 to 3% per year. The math doesn't work. Option 2, default. Just don't pay it back. But if major governments or corporations default, it crashes the financial system. Nobody wants that. So we end up with option 3, inflate the debt away. This is where your money gets hit. When governments print more money to service their debts, each dollar in your wallet becomes worth less. It's like adding water to soup. You've got more liquid, but it's not as nutritious. The numbers tell the story. Since 2008, major central banks have created over $20 trillion out of thin air through quantitative easing programs. That's new money that didn't exist before, injected into the financial system. Meanwhile, your salary probably hasn't increased by anywhere near that proportion. This is why housing prices have skyrocketed, why college costs keep rising faster than inflation, why it feels like your money doesn't go as far as it used to. Because it literally doesn't. When the money supply increases faster than the supply of goods and services, prices rise. It's basic economics, but the connection to the debt crisis isn't obvious unless you follow the money trail. Every dollar created to service government debt is a dollar that makes your existing dollars worth slightly less. Now, some economists argue this isn't necessarily a bad thing. They point out that debt can fuel economic growth, that inflation can help reduce the real burden of debt over time, and that as long as people have confidence in the system, it can continue indefinitely. And they're partially right. The US has been running deficits for decades and is still the world's largest economy. Japan has debt that's over twice the size of its economy and hasn't collapsed. But here's what's different now. The debt is accelerating faster than ever before. Interest rates are starting to rise, and geopolitical tensions are making people question whether the current system is sustainable. When confidence starts to crack, things can change very quickly. So what does this mean for you? First, understand that this isn't financial advice, but it is financial education. In an environment where debt is growing faster than the economy and money is being created to service that debt, assets tend to outperform cash over time. This is why we've seen massive growth in stock markets, real estate, and even alternative assets like cryptocurrency. People with assets get richer, while people who hold cash get relatively poorer. Second, be prepared for volatility. When debt levels get this high, small changes in interest rates or confidence can have massive effects. And finally, stay educated. The more you understand about how money and debt actually work, the better decisions you can make for your financial future. What do you think? Is this debt growth sustainable, or are we heading for a major correction? Let me know in the comments below, and if you found this explanation helpful, make sure to like and subscribe for more money facts that actually matter.